Welcome to the Strategic Investor. Join us as we interview some of the world's most productive asset managers and uncover sophisticated and unique investment strategies in the markets. Here is your host, Charlie Wright.
Hello and welcome to Strategic Investor Radio on OC Talk Radio, where we bring you investment strategies you are not hearing elsewhere. We'd like to welcome to our show today our guest, John Harnisch, CFA, Portfolio Manager for Shelton Capital Management. They are a family of mutual funds. He speaks to us from his offices there in Greenwich, Connecticut. John, welcome to Strategic Investor Radio.
Well, thank you very much for having me, guys. I really appreciate the time to talk about our portfolios and what we're trying to achieve over here.
Okay, so John, you came out of Fargo, North Dakota to go to Trinity College to play tennis. You went then directly afterwards into the investment management world, and now you manage the Shelton Tactical Credit Fund, and you've been a CFA for 12 years here. So give us a little background of yours, will you?
Yeah, absolutely. So after graduating from Trinity College, I started my career at what was then called Babson Capital Management. That was the firm that was the institutional asset manager for Mass Mutual Financial Group. The company is now called Barings. So I started out in structured credit, basically analyzing internally managed CDOs. We were a very large structured credit manager. I did that for about 15, 16 months and decided I wanted to get into, really kind of the nuts and bolts on the research side. So I transitioned from the structured credit team into high yield research, where we covered a variety of strategies, call it mutual funds, absolute return product, structured credit product, and helping to manage Mass Mutual's general investment account. So I was there a few years, became the senior analyst covering about $1 billion and a half of assets managed under my name that I was responsible for. And then I decided, you know what, I want to kind of go out there and take a little risk. It was kind of an interesting time where I started taking this risk. This is in 2007. And there was a hedge fund looking for basically a generalist analyst to help out on the convertible arbitrage arena, in addition to helping out with their trading of their credit default swaps. And, I knew somebody that worked there, and I was given the opportunity, and I made the move down here. The firm was down in Greenwich, Connecticut. So I basically helped, like I said, in the research side. I managed a credit default swap book of about $500 million on both the long and the short side. So we were really taking, some fairly large bets. We were about $1 billion firm. As you know, the convertible bond market exploded in 2008. That was probably the worst performing asset class with, managers down anywhere from 35 to 75% across the board. It really didn't matter how de-risked you were. It was basically leverage was taken out of the system immediately, and convertibles were a leveraged product.
I remember it well, John, believe me.
Yeah, I remember it too well, actually. I got some really good stories, which we can get into in a bit. But so we kind of decided at the firm, we had to make some changes. And my background was clearly in high yield, bank debt, investment grade, but really my expertise was in the high yield side of the ledger. And we said, you know what, this is a more liquid market. There's more things to do. It's healthier, even though we are still in the credit crisis. And my bosses said, do you want to start a credit hedge fund? You're going to run it, aside from the convertible hedge fund. So I started a fund, and it was a strategy that was managed sort of like this strategy that we're running right now, which we're going to talk about. But it was more of a levered strategy, more larger bets, more trading. So I started doing that, and along the way, two other asset management firms came to us and said, would you like to run 40 Act mutual fund money for us in the high yield space? So I took that endeavor on as well. So I was managing two other mutual funds in addition to managing the high yield fund. And then this opportunity came around in 2014, where they'd seen that we had some really good success managing, high yield assets in the mutual fund vehicles, which again are daily liquidity without the use of leverage. We talked to them and they said, hey, John, would you like to run this type of portfolio? So we started it in December of 2014 with about $4 million. I mean, it was teeny. And we were able to kind of piggyback off, our relationships and all that with our other high yield investments. So we had some really good success to start. And the fund grew substantially in the first 6 months. We raised about $50 million of assets. And then the firm that was kind of the advisor, we were the sub-advisor, got into financial difficulty. And we had to basically make a move with respect to the portfolio. And that's really how I ended up at Shelton. Shelton wanted to take us on, and they did. So I've been running this strategy, contiguously in this vehicle since December of 14, but really a high yield PM since call it 2009.
So John, you used a couple of words. I'd like to take a little sidetrack here, but we need to make it quick so we have plenty of time for our interview today to focus on your tactical credit fund here. Sure. But you gave the term CDO and swap, which basically were, and for many people still are, four-letter words. Okay? So in 30 seconds, what do you see from the 2008 credit crisis from the inside that the rest of us haven't seen and really don't understand?
Well, I'd say, to be quick with this answer, the credit defaults, the CDO market or collateralized debt obligation market is a very opaque, very, very leveraged product that all the CDOs or those instruments that have been issued by the banks, they basically own all the same collateral inside of the vehicle. So when one CDO gets into trouble, they basically all get into trouble. And that was basically what happened and why the crisis started. On the swap market, swaps were not regulated back in 2008 like they are now. So there was a lot of counterparty risk. So if you had a swap on with Lehman Brothers, you were basically buying their credit in addition to the credit that you were buying. So when the CDOs blew up, then the swaps blew up, and then everything kind of fell into the pile, and that's really how the crisis started. And from the outside, if you're not in the finance business, you just don't really kind of see the underpinnings of how these vehicles were kind of intertwined.
I can appreciate that last comment because we've had a couple of interviews specifically on the credit crisis of 2008, and I've read more than one book on it, including The Big Short, and even saw the movie, and it's all an enigma to me, I tell you. and I hope it's an enigma that I never have to deal with again.
I was just going to talk about The Big Short. It was very accurate. It was written well by Michael Lewis. But it really shows how there was no risk management. It was an industry that was built on greed, because the bankers and the traders at the time are getting paid exorbitant amounts of money just to, sell these deals to anybody who would buy them or make these, trades that they really didn't understand, that the traders didn't understand. And that was really the backdrop of the crisis. It was just way too much risk, way too much greed, vehicles that just didn't make any sense in any environment, if you ask me. So I think that was a fantastic book, and especially for someone who's not in the industry, you can kind of understand what was going on.
Yeah. So let's move on here. We could talk about that all day here. So tell us about your tactical credit fund and basically how it works. Sure.
So the Tactical Credit Fund is a fund that is clearly a fund that is focused in the credit markets. It's a little different than a typical credit fund, whether it be a high yield fund or an investment grade fund, what have you. It's based off of 4 asset buckets. So typically high yield, bank debt, convertible bonds, and investment grade bonds. And we're able to do that because of the extensive backgrounds that both myself and Chris have had over our careers, where we've not just been siloed into one different, call it high yield. So the tactical part of it is, let's say high yield's doing really well. We're going to, place our bets in high yields. Let's say high yield's out of favor and convertible bonds are very, very interesting. We're going to buy convertible bonds. So we can move around the typical asset buckets, which a traditional manager can't do. So that's one part of the strategy. The strategy is also run long short. So it's not just a long only passive vehicle. It's traditionally been, highly focused in the high yield space. And when we say high yield, we think about 2 different buckets. We think about a short duration bucket and a longer duration bucket. The short duration bucket are bonds that we believe have durations of 0 to 3 years, whether there's an actual maturity or it's a yield to call or it's a callable instrument. And these are typically instruments that were issued 5-6 years ago, where we were coming out of the last credit crisis. Coupons and spreads are very, very high. So the rates of return on these securities, even though they can't really move up in price, the current yield you receive on them is significant. So if you look at our portfolio, that's really the ballast of what we think in terms of high yield, because we can get these current yields, significant, cash flows for the portfolio, and also at the same time eliminating mark-to-market volatility, because they can't really move too much because they're short duration, and they don't really have too much interest rate risk, because if you think about it, the 10-year curve is not going to really impact a 1-year bond. So that's the bulk of our book. The other part of the high yield space is going to be 7 to 10-year longer duration bonds, which exhibit significant mark-to-market volatility, which will sell off or do very well depending on market conditions. Now, what we like to do here is we focus on certain names and certain credits. So if the market sells off, there's a lot of volatility, we'll sell the short duration bond and buy the longer duration bond in the same capital structure, which has been now down 5 to 7 points, wait for volatility to subside, and then we'll shift back from the longer duration part of the capital structure into the shorter duration. And that's the real tactical nature. We're moving around the capital structures very, very frequently. So if you look at our portfolio turnover, it's called about 250% a year. We do this trade all the time. It's what we call the rotational trade over here. So that's generally the ballast of our high yield exposure. What's a little bit different, and I just want to dial down into this, and then I'll talk about the shorting. We're very focused in certain sectors. We're not an index type of vehicle, and we're very good at certain sectors where we think we are. Industrials, services, aerospace and defense, telecommunications, healthcare, industries that exhibit very similar characteristics. So when the economy is moving around, revenues don't generally deviate more than 5%. Free cash flows are generally 5% of total debt. These companies have real assets on the balance sheet, so if our fundamental analysis is wrong and the company's getting into trouble, the bonds have recovery value, or they're going to hold price better because they have tangible assets that are due to you as a bondholder. Generally, the capital structures are very, very clean. So these are what we really like and are really the focus of our fund. So I'll think about 100 different names with maybe 5 to 7 different bonds in their capital structure, where we can do this rotational trade depending on what the market conditions provide us. Bank debt, clearly, it's a high yield instrument. We have not really been too long bank debt. We just don't think the value is there. It's generally the same companies where we're buying the bonds, but the yields are much lower. And basically, covenants have been becoming very, very important in this space. So it's not really a loan or a senior secured vehicle, if you will. It's more like a bond. So we find the value in the bond part of the market. And then finally, on the convertible and investment grade side, this is where we look more for our shorts, or what we want to short, given the lower coupons than a typical high yield security. The fact that you can short an investment grade bond and it has a lot of interest rate risk. And guess what? If there's a credit downgrade or an activist situation, the spreads are gonna move out quite quickly. So it's a very asymmetric type of trade. So that's really the way we think about it. It's simple. It's repeatable. It's no black box. It's based on a macro viewpoint, what we think is going on in the world of risk, and then we couple that with the fundamental analysis. There's just 2 final points about the portfolio, or 3 final points that I think they're very important. We try to not buy any distressed securities because liquidity is paramount to this strategy, because, again, we have to rotate between the different parts of the capital structure. And distressed securities become very illiquid when the market's going up or when the market's going down. So we try to stay away from that. Second, we try to stay away from bonds that are generally held in the JNK or HYG ETFs, because the ETFs have a significant amount of volatility depending on market conditions. So sometimes you can't even sell a bond if you want to, because the ETFs are just selling indiscriminately and they're moving bonds down 4, 5, 6 points, and it creates a lot of volatility in your portfolio. So we try to find the bond in the same company that's not in the ETF, but it has an ETF type of security. Not to say we can't buy the ETF and play technicals, we can do that, but we try to stay away from that. And third and finally, I think the most important thing with our strategy and why we've been successful doing what we've been doing is our risk management. I think Chris and I do a fantastic job managing risk. We're not closet indexers, like I said, so we're not a big asset management firm where all of their competitors own the same bonds and they're down 50 points and they don't really care because everyone's market weight and everyone's returns are relative. That's not the way we think about it. We're quick to cut risk. So, for example, if we have a bond that's down 20 basis points on the portfolio, we'll throw 50% of it out, 50 basis points, and it's completely gone from the portfolio. So I think those are the important facets of what we do and what we try to do, and I think that's what kind of separates us from a typical credit manager, if you will.
So, John, here's a question. For some period of time, Barron's Magazine, which I've read religiously for decades, they would interview a particular very successful high-level investment advisor and put a one-page summary of that interview in the magazine. And they would show that investment advisor who was managing hundreds of millions or billions of dollars, some huge amounts. And they would ask them, okay, what do your typical clients own? Well, on the equity side, typically the article talked a lot about the equity side, but they would typically talk very little about the credit side. And most of the advisors were not at all original or out of the box in any way on the credit side. So I'm sure I'm not telling you anything new here, that advisors and I'm sure investors know much more about and get more excited about the equity side than the credit side. So what do you see, being on the inside, being Mr. Credit here, what do you see as misperceptions of the credit industry or credit investing that so many investors and advisors are missing?
I think the misperception, if you will, is that bonds are very boring. There's really no way to make real returns in certain parts of the credit markets. It's not on CNBC. When no one talks about high yield. That's a problem in terms of getting out the story. I think people don't understand the inherent risk of just buying a boring book of investment grade bonds. There's significant investment grade risk. There's really not a lot of price appreciation, and it's doesn't have the word Amazon attached to it. A lot of times these are really kind of small companies that don't even have public equity. But these are names that in periods of volatility you can make, first off, significant returns, which I think advisors, it kind of sometimes passes them by, or retail investors. And two, you can move around to different parts of the credit markets, whereas the equity market is the equity market. It's just one market. The credit market is dynamic. It's not just one, boring, state old place. There's high yield, there's bank debt, there's investment grade, there's emerging market debt, there's distressed. There's just a lot different kind of stuff that you can do that I just don't think the story gets out there. And I think if we can get that out there, it would get people more excited. And I also think the typical, 60-40, kind of investment philosophy that everyone kind of seems to espouse, you need to have equities clearly, and you need to have fixed income clearly. But having that 40% in bonds, just regular investment grade passive vehicles, doesn't make any sense. You got to have 10 to 20% in alternatives like the tactical credit fund, where there's real rooms for making alpha. When the equity market's selling off, we can make a lot of money in bonds, or vice versa. When just the passive market is fine, we can lower our alternatives exposure. So I just think getting the story out it's hard, clearly. And I think, losing the perception that bonds are just, you can't lose money. There's nothing to do. I think that's the real problem.
Hey, I really appreciate that answer. And again, 300 plus interviews here. We really haven't had that kind of input. And, investors and advisors typically just kind of skip over that whole area of credit. And it is deep and it is wide and it is interesting. But somehow, like you say, the story has not gotten out there. Okay, change the subject a little bit. What would you say, John, is the best advice you've ever heard, read, or received about investing?
I would say the best advice I ever got from investing was from one of my old mentors at the hedge fund. And he said, the best way to make money is to not lose money. And I'll always remember him saying that because, the markets were were very, very volatile at the time. I think that was 2009, 2010, and high yield was moving around quite a bit. Clearly, equities were moving around. But I think that really bestowed upon me the real risk management philosophy of the tactical credit fund. Because if you look at how some typical managers run their portfolios, clearly there's the passive investment group that they don't really care because they're benchmarked to all their peers. But then there's managers who take really outsized risks. If they're in a really bad position, they double down, or they fail to realize the risk of the position in the overall portfolio. And I think that's really the key to making money, is just not losing money. So, you know what? Sell the position first, and then you can always buy it back. But mitigate the downside, and don't I guess kind of a slang, but like gunsling it, if you will. And I think that's the key to success. So that was the best piece of advice I think I've ever gotten.
Hey, appreciate it. So I presume that clients of the Tactical Credit Fund are retail investors, advisors, family offices, institutions, etc. Who are you guys really focused on, and why do you think they invest with you?
Yeah, I would say the typical person we try to focus on is retail, family offices, and investment advisors. I think retail investors maybe are kind of circling up because the performance is good. It's a 5-star fund. It's okay, I'm just going to buy it because it's a safe bet, if you will. But I think in the advisors and the family offices, I think you get some really sharp people that understand. Some smaller managers like we are, we're a $50 million fund. They provide a lot of alpha versus, a typical, I'm not going to name a name, but a large, $1 trillion asset manager, where if you can find these guys, like such as ourselves, you can really do quite well for yourself. So I think that's why they kind of gravitate to us. And, their portfolios aren't, billions of dollars. They run $100 million, and a $1 million allocation to someone like us is meaningful for them, and it can generate real returns for them. So I think that's why they gravitate towards a portfolio like ours.
Okay, and that all makes sense. So tell us, John, a question we like to ask all of our guests: what keeps you awake at night? Now, I know that you played tennis in college at Trinity College. You now have a 3-year-old, so she probably contributes to that. So what keeps you awake at night? Yeah,
I mean, for me, there's two things that I get, I'm worried about. One, on the micro side or the fundamental side, did Chris and myself do the correct credit underwriting and buy the securities that make sense in the portfolio? One, but two, from a fundamental perspective, they're not going to explode in us in default or have a financial fraud, something like that. That's more on the micro. On the macro, really it's an exogenous event that keeps me up at night. So when I'm thinking, war with North Korea breaks out, or there's some sort of tangible illness that comes out of like Ebola and it spreads, something like that. That's really what keeps me up. I'm not concerned right now about a banking crisis or the equity markets falling apart. It's really an exogenous event, I think, on the macro side.
You're not the only one concerned about those things, John, believe me. So for those who would like to know more, give us contact information, website, etc.
Sure. So our general website is www.sheltoncap.com. That's
Spell Shelton, will you?
Sure. SHELTONCAP.com. We'll list all of the funds that we run and, our strategies and general news about the firm and all that, so everyone can see what's going on the overall portfolio or overall business. And then, on a daily basis, it's going to be myself and Chris Walsh are definitely the points of contact here. So my name is spelled JHARNISCH. That's also at sheltoncap.com. And then Chris is C. Walsh at sheltoncap.com.
Okay. Well, John, we really appreciate your sharing a few minutes with us here. We offer our best wishes for your continued success together with Shelton Capital. Give us final words, will you?
Sure. I would say just, to put everything in perspective, fundamentals are probably the strongest I've seen in 5-6 years. The macro backdrop is fantastic. Whether you like it or not, the tax cuts are working. People's balance sheets are getting better. Corporations are healthy. Credit markets are open. It's just putting all that together and packaging it into one. It's a real recipe for success and continued market strength. So it's that, and a lot of the systemic risks have really been removed from the system, which again goes back into the good fundamentals and macro backdrop. So, in conclusion, I think while we've had a strong bull market for the last few years, I don't really foresee this changing anytime soon, unless again we have one of these exogenous events or something that's just unforeseeable. But we feel very strongly about how we're positioned, where the market is.
John, we're out of time, but I just realized I missed a question that I wanted to ask you. So if you can give a brief answer, we'd appreciate it. The inverted yield curve. We read all the time about the inverted yield curve is going to be the canary in the gold mine, in the coal mine here, about if we're going to have a recession. You're dealing with yield curves all the time. Your quick assessment of that position.
Yeah, so the difference in the 10s and 30s right now is about 20 basis points. So it is the curve has flattened. I don't know if that's a real sense of a recession coming down the pike. I think people are looking in the bond market for more yield, and that's generally what causes an inverted yield curve. So no, I don't foresee the curve inverting. I mean, I think the last time we did inversion was in 2000 with the tech bubble, but that was a portend of what was to come. But it does not keep me up at night, and I don't think it's really something to get too worked up about. That's kind of my thought process there.
Hey, when I take my nap this afternoon, I'll sleep better here, John. Thank you very much. I really appreciate it. Hey, well, again, John Harnisch, CFA, Portfolio Manager for Shelton Capital Management, specifically for the Tactical Credit Fund. Thank you very much for joining us, and we hope things continue to go well for you.
Thank you very much.
Again, you've been listening to Strategic Investor Radio. John Harnisch, CFA, Portfolio Manager for Shelton Capital Management. We'd love to hear from you. You can contact us at info@strategicinvestorradio.com, and you can go to our website to hear podcasts of all of our interviews and shows, strategicinvestorradio.com. I'm Charlie Wright, wishing you an enjoyable week and productive investing.
Strategic Investor Radio is a production of OC Talk Radio and is provided for educational purposes only. Content of this program and the views of the guests should not be considered as recommendations by OC Talk Radio or investment advice from the host Charlie Wright or any other entity attached to this production. Investors should always consult qualified financial, investment, tax, or legal professionals prior to investing.